We're going to go over specific strategies going into spring for corn and soybeans with options. And then we're going to look at the corn-wheat spread, the soybean spread versus corn, and the ratio. And then also we want to look at the cattle market and then what we're tracking for the potential top to the cattle market seasonally. And so that covers quite a bit. And then what do you have?
I got nothing.
Well, then this will cover a lot.
Welcome to Hedge Heads, where hosts John Prishman and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, John, we've been making some changes around here, and there's some stuff coming up, and I'm just teasing that for later in the podcast if people want to hear some news. But let's get to the important stuff. What do you got on spreads today?
Well, I meant first and foremost, we're going to look at specific ideas going into the March 31st report. But one spread that's got really on my radar screen is going to be the corn-wheat spread. Corn is at 60 cents, I think, in the front, maybe 55 Friday, and versus the corn price. Wheat is still over corn, but that's normal. It's not normal for you to see it even this narrow, being 55 or 60 cents up front. Now, if you go back to the back end of corn and wheat, it looks very different. You have carry in the corn market, or not very much carry, and inversions all the way back to 25 in the corn market, and then you have heavy carry in the wheat market. So the real opportunities up front, the problem I have with up front is that it's a lot more dangerous. You have two different corn markets, one that's tight, or I should say tighter, and then you have one in the back end that looks like there's going to be 96 million acres. So I like the back end, but you follow the front, because why it's important is why this spread exists is it's a feed relationship. So the wheat will make it into the feed channel. So what's normal in this spread? 167, I believe, is what they say is normal. So corn, there would be corn $1.67 under wheat, and that's a normal market. This one's, with all the fund buying, has gotten corn way ahead of wheat. And not only that, they probably have near a record position short wheat. So you have two extremes. They're heavily long corn, heavily short wheat. At some point, this will change, and there comes the opportunity. So the levels that are important is it gets to be overpriced. They say about 220. The median is going to be 167, and then what would be considered cheap is right now at 60 cents. Seasonally, we're not in the right time frame, so this is not something that you rush out to do. But we are going to track this spread. This one, I think, is going to be a real important one, and I think it's also going back to the median, obviously, at some point in 2025. What do you think?
I think I don't trade the corn wheat spread, so I don't pay attention to it because it's spendy and riskier than I like. But I think it makes a lot of sense from a feed perspective. Like it's more real and less influenced by outside forces. So there's definitely opportunity there.
Yeah, it's a little different than the corn and the soybean spread, which they say to put 2 corn on for every soybean to kind of even it out, and that's the way they look at it with the ratio. And that's at, I think, 227, somewhere in there. So that's considered very low for that spread as well. So you can see how corn's got these two extremes against wheat and soybeans. Soybeans have gotten a lot longer in the fund position, and it's not the same situation as wheat. But like you say, it's two different markets. This is not a spread for the faint of heart. This spread moves. It's known to move a lot. I feel much more comfortable when I'm long wheat and short corn than short wheat, long corn. And that has a lot to do with the world news and the world politics, because one problem in a major country like Russia or anything else with wheat, or Ukraine, Russia, that we saw that wheat will just take off versus corn. It's been $6, $6+. If you look at the Minneapolis spread in 2008, probably closer to $20. So never say never in wheat to the upside, at least in short term. So I'm much more comfortable the way it's structured now, short corn, long wheat. And I'm very interested in the December contracts, even though they're at $1.40. $1.39 versus 60 cents in front. Much less risk short term in the back end than there is in the front. And I think two different markets. So the corn versus soybeans, very interesting ratio and very important. That's a spread that's not near as popular as corn and wheat. But like you said, they're both very dangerous spreads to be in. They're going to be moving a lot and they can go two different directions against you. But this is something that's really important and running in the background. And it's being mentioned more and more on Twitter every day, or the guys that do follow it. But it's something that you just sit there and you track. You don't just, hey, I saw this today, let's get in this. This looks cheap. This is one that you want to get familiar with the way it moves and then try to time it. I'm going to try to do it with seasonals. And I believe we have at least 8 weeks before the seasonals do turn. But just one piece of news can change the outlook of the spread too. And if you think the funds are going to cover their wheat shorts, obviously it's going to work very good in that time period. That's a very hard one to calculate because they'll stay short wheat indefinitely, these funds.
Yeah, I think, I noticed on your Twitter over the last week, you've been sharing a lot of spreads. And I think starting to track some of those is definitely just watch where it goes, watch where it moves and what it's doing, but also know why these relationships matter and kind of start to educate yourself on those is important.
Yeah, I think it falls out of favor really quick because people live in a world where they want a hot trade. They want something on today that's going to make some money. They don't want to sit and watch this stuff develop. I've been watching that hog spread. How long? 4 months?
Yeah, at least.
And I might be 2 more months before I'm in it. I'll track stuff as long as they have contracts out there that are liquid. I also put on Twitter the February 26, April 26 cattle. So I'm not afraid to be patient with it and let it develop. But I think it really falls through the cracks because people get into commodities for stuff that's going to move.
They want the action.
Yeah, they want the action, and it just doesn't fit. And then a broker of all people, who's he to recommend these? These are long term, not very many transactions. So it's not popular in that world either. Even though it's two sides, still they can be held for much longer than generally outright positions are. So it's just one of these strategies that falls through the cracks. And there's a couple very good outfits online that do track these, and they do put out recommended seasonal stuff, and I do follow both those. But it's just one of those things where we talk about them often, but a lot of people will follow it for a few days, then they get bored when it doesn't have, like, the July November's bean spread, for instance, has just been going straight up. It gets on everybody's radar screen when it's really moving, and then when they get to be normal, then everybody walks away. And you'll hear things like, I don't know where one contract's going, much less two contracts, and then they'll laugh at the end of that. That's pretty much everybody in the commodity world except for guys that follow spreads. It really isn't like that. You don't need to know both directions. It's just general fundamentals. And again, I don't know how anybody even markets their corn and beans or anything really without some general idea what contract to be in, when to contract. So you don't have to have an account here and be doing spreads. You just need to be familiar with what belongs where for a lot better marketing on the farms. You can make anywhere from 30 to 40, 50 cent differences to the better side when you're familiar with where these belong. Of course, there's going to be years where it doesn't do what it's supposed to do. And I would say this year was one of those. Everybody was waiting for the corn roll. And then the corn just kept going up in the front versus December, and the ideal window was the low, which would have been in that August, September time period, and then it just has gotten more and more narrow. So the roll waiting on it this year did not work, where last year really rewarded a guy all the way into March.
Yeah, it's definitely been a different year, which is something that we try and focus on, is knowing where and when and why things didn't work, which you don't always know the why, right? But the more aware you are of where the spreads should be, where those contracts should be, the better decisions you can make. It doesn't mean that decision is right,
and you did,
but at least it was more informed.
You did see that in corn this year. The corn spreads have been saying that the numbers weren't right for a very long time. I was on the wrong side of it at the beginning. It has been saying these numbers are coming out at some point in the near future. We saw this in 2020, but this is a lot less bullish than 2020 was. But the spreads in corn had been pointing this out for a very long time. These numbers looked wrong, where it was the opposite last year. They went to more and more carry as time went on. And then where is the carry, which we have been tracking? It is narrowing in corn, March, May, which is a good sign for the pipeline starting to get tighter. And then it's still out there in the beans. I think we're sitting at 10 3/4, 11 for March, May, which doesn't sound wide, but it is actually for March and May. So beans don't look healthy spread wise, where corn looks a lot healthier. And that's the way the markets have been trading. Although you've seen these big blasts up in beans, when the buying's done, it's fallen like a brick every time. So that's something I'm watching right now. I'm also looking for, I like to bear spread beans and corn and bull spread, both sides. But when I'm top picking or bottom picking, that's my preference, is to be in a bull or bear spread. So I am tracking bear spreads in corn. Soybeans, to try to top pick it, which you can go pour trying to top pick soybeans. But it's more of a layup than a slam dunk. And not an outright position, but it's like trading soybeans with an anchor.
Well, and that's where the importance of tracking that spread is, right? I mean, while you should be watching it, take a look at the end of each day, or take a look at the chart. Start watching that soybean spread if you are looking to pick there, or you want to use that for marketing. If you haven't watched it for the last 2 months, whatever, even if it's weekly, what adjustments is it making, and why is it making it to pick a position? Even from my side, like being an option trader, I look at the spreads first.
Yep.
To know where things are at. Where is it going? And then you can kind of decide, well, do I want to take a real short-term swing at this, or is there a long-term option that makes way more sense?
Yep. And you can see that the money flows very easy. It's also, spreads are very good for that. And clearly there's been a lot of money flowing directly into soybeans. Fundamentally, July, November saying, hey, maybe the cash markets are going to get tighter. And we're going to head higher here on spring tightness, which is normal for soybeans. Didn't happen last year, and it's unlikely to happen this year unless something changes with South America. But the money flowing in has really pushed that July, November. So that's a spread that I'm really watching. When that money dries up, my bet is that spread will dry up too. Now, that has a different personality every year, and that's why it's important to get to know what the spread's like. It's been a very quiet spread for a very long time, slowly going down, when normally it's a very volatile spread, normally going up at this time of year. Then suddenly it goes up, and there's my opportunity that I'm looking for. Is just, this is most likely a money flow deal, and it's not a fundamental deal. That's where I like to top pick spreads. Where cattle market's an interesting market. I am following quite a few bear spreads there, and I will be in some, but that is not the same thing as soybeans. This is not a money flow deal. This is a fundamentally bullish market, much more dangerous to do this in than a market that probably is just dealing with just short-term money flow from the funds. Cattle's wise to be very careful, but there is a certain sets in cattle of contracts that are much safer to be in than others spread-wise. And I'd be more than happy to go over specifics with a guy if he wants to talk to me. But I have been in one, and off and on, and it has been working even while cattle's going up $10, and that's why I like spreads. If you're top picking, if you know what you're doing, you might not get hurt if you're completely wrong. And that's definitely happened in cattle to me here recently. So I picked the right one so far. It's actually even up money. I plan on adding more, but it's also very dangerous to do that, to sit there and try to pick a top in any market or a bottom. So I tend to do layups and I go with the spreads, but theoretically they can be more dangerous than an outright position.
Absolutely. And that's the important part of trading spreads. I prefer to watch the spreads and understand how they work in the relationship. I don't mind trading corn spreads. I think also choosing your market too. Yeah. A hog spread's got a lot more
action.
A lot more action than a corn spread.
Yeah.
Yeah. I mean, there's always things that can go wrong, and you can lose all your money, or you can make some.
Yeah. The hogs, you're gonna find action nearly every day. 40, 50 cents is very common for about any spread to move in a day. So $200, where corn, you're looking at $50, $25. I mean, it can be death by 1,000 paper cuts, which it was to me on the bear spreads initially.
Yeah.
Just every day ticking against you. Soybeans and hogs are kind of in the same category. And then wheat can be very quiet, and then it can wake up and be one of the most dangerous markets to be spread in, unless you're on the right side. So you really got to know your markets. But why do we talk about spreads all the time? It's for better marketing. Even if you're not trading the spreads, you see divergences in spreads, or you see them bull spread, which is exactly why I didn't have any short contracts, any hedged contracts of wheat in 2008. And that was specifically because September Minneapolis wheat went above the price of December. And this had to be in July and August, which is very, very uncommon to have the harvest contract to go over the next contract. It nearly never happens unless there's some sort of delays or a short crop or something. So this was a normal crop, what seemed to be a normal year so far. But September got suddenly inverted to December. And for a guy that had followed those spreads back then, that was exceedingly uncommon. So it kept me out of a lot of potential trouble. Of course, you can't measure that, but that was a market I watched. Sure, I would have liked to have been long a bunch. And guys did get in and out. But at one point, I think the margin was, you had to have 15,000 in your account, not at the end of the day, not 10 minutes later. It needed to be in your account before that wheat contract went on, or long or short. So it got very wild back then, and eventually it just kind of margined everybody out. It was just moving around too much. But that was, I do remember that the spreads will often tip their hand before it happens, and that definitely happened that year. So I think we should talk about, we've given a couple updates on these short dated options.
Yep. So
more specific strategies going into spring of what a guy after this report, what maybe a guy should be looking at for different ideas on corn and beans. So I was going to send a sheet out to my clients. It was going to be beans, corn, and cattle. And then it was going to be specific ideas, in a lot of different categories. But then the report happened and really changed things. So we'll kind of give you an updated version of maybe what we're looking at with the short dated stuff. I don't know. For me, it changed a lot. What do you see?
Well, definitely on the corn side, it changed significantly. Yeah. In that, we were talking 430 and 440 that we were looking at puts, and now 480s in play.
Yeah.
And last week we mentioned even not looking at the short dated, not the OCD contract, but actually going all the way to December and having all that time.
Yep.
Now volatility has picked up a little bit this past week, so that price is moving around a lot.
Yeah.
There's not the option. I don't think it's gone up enough where you could add a call to that or shorting a call to that yet. But I didn't look at numbers on Friday, so
yeah, I would agree. It's changed. So the way it's sat is we were looking at 440s even for July and maybe 20 cents. But after the report, and I hadn't done anything, but after the report, the numbers really have changed. So the question is, are we even in the same time frame? Here's your two choices for May. You have like 460s for 19 3/4. One would look at and maybe get that for 16 cents to make sense, and then 450s for 14 cents. That's in the May time frame off the December 25 contract, and that's 95 days. You look to July, the one I liked, 450 for 18 cents. That has 123 days. Now, what the big change for me was not those numbers and doing something tomorrow, is that we might have a lot more time to think about it now. Before, it didn't feel like it, and now with that new number, really supports it into the next report. Where corn, I think, is going to struggle is that March report. So what it looks to be is very supportive going into about March 10th, and then beyond that, they're going to probably start thinking about all those acres, and it'll change from this old crop bullishness to let's just focus on the new crop, and it potentially could get bearish if they decide to just adopt that attitude. So the big change for corn for me was, do we just sit on our hands here and wait after that report? And it's starting to look like it, but we do have a lot of Trump talk with tariffs and all that coming up. And then the bean one didn't change my mind, even though it was a supportive number. It seems like a guy needs to be in somewhat of a hurry, especially with beans coming up sharply. And the one that stood out to me was maybe a May short dated going off the November 25. Seeing how beans are more bearish, you could use, even though they tell you not to use the different crop here to cover your other crop, potentially the front could fall more. So, you can look at all the options. Still, the short dated 1020s were 31 cents. Am I fired up about that? Not really. I mean, it just feels like that report put in some sort of, now we can think about it for a while. So I haven't put out that sheet for that reason. What seemed to be like a big hurry, now it's not as big a hurry for me, but that could change with a couple tweets tonight.
Right. Well, and I think from the soybean side, from my point of view, is there was zero opportunity to do much at a profitable standpoint.
Yeah.
Where now there's opportunity, but I agree. I feel like we need to pick something soon if you're looking to protect not your whole crop or not everything you're planning on, but I'm actively looking for shorter term options on the soybeans. Now, they have between now and Easter. Do you need to jump in there? I mean, the seasonals would say no, but like you said, there could be a tweet tonight, or the tweet could be, hey, we're going back to the original trade deal and we're shipping all this stuff out.
Yeah, it's that, and that's what my point was for corn. Everybody's written this corn off for next year already, and it's like, and I can't tell you how many calls I've had, and some of them are newer guys. With everyone's locking in this December 25 price, so you finally get a year where corn can go up substantially, and everybody seems to be in a hurry to take that upside out. So the trade deals could go good. A lot of things could go good, and we don't know. And that's another thing. Back to when I say the 460 maize cost 19 3/4 or 20 cents. I don't mean burn 20 cents to zero. Like if you're going to, a lot of times you'll use that as a vehicle, like meaning that I plan on losing 6 or 7 cents here if it goes good and things are quiet for the next month and a half, 2 months. But why would I do that then? For all the news that's going to come in the next 2 months, which could make it go down quite sharply. So you don't always look at these with the idea that I'm going to hold it to the end. As a matter of fact, that's usually the wrong thing to do. It's that I'm going to use this as a vehicle to see what happens over the next 8 weeks. That's where I'm at. If you are hedging here, is that you're worried that the policies, the politics of things are going to make it go down quite sharply. And truthfully, that's what he's been saying, is that this is going to happen. How the other countries react is going to be the big mystery this time. So you're just using these for vehicles. So let's just say you buy a 460 May. This goes off the December contract for 20 cents. And that essentially locks you at 440 worst case scenario through the next 95 days. You might only use it for 3 or 4 cents, get a better feel of what Trump's going to do, and then get rid of it. Like you can just have these insurance for these little windows, and you're only going to burn a portion of that premium, or you might not burn any of it or a penny on either side. There's a lot of shades of gray, but you don't just automatically lose 20 cents if you're wrong at all. And that's the way I trade a lot of the options in the spreads and the hedges, is that we're most likely going to lose a portion of this if we're wrong, but we're going to be at a higher price. So you hear the premium, but it does not mean that's what you're going to risk entirely on the trade, because it doesn't move that fast, and the premium doesn't burn out of it that fast.
Well, and another way to look at it too is if you feel like December is going to adjust, like you want a December put, but you don't like the price right now,
Yep.
you can get those shorter term ones, hold them for 2 months. Maybe you're burning half that premium, but the price does get better on those.
Yeah. And
longer term options.
And
too.
if you have to roll up your puts, that's a good problem to have. It means that it's gone far enough for you to sell your old one and buy a new one. So you might net out another 15 cents to lock in 25, 35 cent higher. It's got to make sense mathematically to do that. We haven't had those markets for quite a while in corn, and we haven't had to do that. And when we've had these markets in the past, a few years ago in corn, it didn't seem like we needed a put. These were solid numbers with demand growing, and it isn't the same situation where a few Trump tweets and we could be coming down very sharply tonight. So I would say more, if it wasn't for the politics, I would be less aggressive even looking at this. But you look at last year and you look at these simple numbers, when you like, I don't have the December options wrote down, but last year it was $5 for 35 cents. So you have a 465 floor. No one knows what the weather is going to be, and that's kind of the whole point. You can just go farm. You got your insurance bot, you got your level, and it was really black and white last year. This year, like you said, there's not a lot of meat in the bone, so it's a lot harder. And then you throw politics in, and it's a guessing game with supportive fundamentals in front for corn, very bearish fundamentals looking for beans. So it's a very different year, and I think a guy just needs to take his time and not rush into things, talk it over. Hopefully we have a little bit of time to decide here.
Yeah. Speaking of time, we're burning through time on the podcast, so we should get to the cattle markets, because you were talking about, the last thing I heard was 2026 cattle is what you're watching in spreads.
Oh, yeah.
What are you watching?
So you go back all the way to the back end. February is inverted over April, and that is not common, especially when it's that deferred. And that really has to do with nobody being involved in 26. So February is just going to naturally get pulled up a little bit faster when you're in a steep uptrend like we're in. So I would be when I'm top picking, I'm looking at bear spreads way in the back end. Although I'm not doing any of this right now, that's stuff I start tracking. You start getting $1 or $2 above that. Yeah, and then go into a seasonal time frame where generally the bear spreads work. That's something that'll do then. Right now, you're just in a rip-roaring bull market with really no end in sight. If anything, the futures are a little underpriced. They're lagging cash, and feeders have been trying to play catch up. But it's where I'll begin my cattle, like on the spec side, and then on the hedging side of stuff, been very quiet, really. I met a few guys, some short contracts, and nothing on the put side of stuff, except for on the spec side where like short, longer term, cheaper options, but really very, very quiet. And it probably has everything to do with the LRP, or the livestock risk protection. I think a lot of guys have moved towards that. I'm not a big fan at all for a lot of different reasons, but that's where I think that the main focus has been, is these insurance policies.
Yeah, I would say, like you track spreads, I've been tracking some of those options on cattle, because we have some seasonals. We are still under cash. At some point, things could change. So yeah, I just start tracking, where I put sitting. How do they react when cattle are down $2? How do they react when cattle goes up $2? And start tracking some of those options, and whether that's, usually over multiple months that I'm tracking that too.
Yeah, and you're talking diversions, which I like in spreads too. So you'll see soybeans up really sharply one day, but the July, November, them bear spreading that, and then maybe that 2 or 3 days in a row. I consider that a divergence. And same thing with options, like you were talking about, what seems to be a big move down in cattle, $2 or $3, but the options aren't moving very much. And that's the pattern we've been in. They just expect it to be a 1 day correction and for it to go up. But attitudes can change very quickly. So divergences and options, which is implied volatility, very, very important to watch as well. And we don't expect you guys to watch all the stuff. We enjoy talking about it and we watch it. You just would need to, be able to check in with us a little bit more, and we'll cover that for you. And, we have that coming out very soon is going to be the subscription side of that. And that's, we're going to cover a lot of that on those daily, well, I would say on average daily updates.
Yeah, that's what I did tease at the beginning. So just a note, we do have a new website, thehedgeheads.com. You can go there right now and sign up to get an alert when the podcast is released each week.
Actually, I think it's live tomorrow late afternoon. By the time you hear this, it should be live.
Okay.
Yeah, compliance, and we got other things to go through, but it should be live very soon, and you'll be able to go subscribe to what you want to subscribe to now.
Yeah, so that's initially we have the sign up free alert. Podcast is out. We have a newsletter summary of the podcast. Those can come directly to your inbox, or if you want a text alert. And coming up soon, to be named, to be approved by compliance, all that stuff. HedgeHeads Edge. Well, something
that's
that you can't. Yeah. We got to work on John's enunciation if we're going to call it that. So.
Or the name.
Or the name. We'll have some daily, near daily updates, sometimes multiple times a day if markets are moving, right? I mean,
it's going to be your digital broker that you've always wanted in your email.
That's right.
Yeah, well, at least that's what we're going to attempt to do. Trying to get out messages that seem important that you should be paying attention to. And it's, again, not to be promised daily, but I would say average, it's going to be one a day. When there's hot trades going on, maybe two.
Right. There could be quite a bit of volatility coming up. So we'll see.
Things change.
That's a big part of it.
Yeah, things change throughout just the day. So it'll depend on the day. And if nothing needs to be said, nothing will be out there. It isn't going to be a market recap, which you have plenty of. It'll be more towards what we talk about in the podcast, but tracking it in real time.
Yeah. Yeah, we don't. We're not going to sit here and read the quotes. You can turn on your AM radio if you want those.
Well, that's about all I have for this very cold Monday.
Oh my gosh, it's awful out there. -45 is what it said for the wind chill when I left the house today.
Yeah, this one might drag on a little bit. You might have tuned out, and you wouldn't know because you'd already tuned out. But we're avoiding the cold. There's no reason to be outside or anywhere near outside.
Right. So they don't have to go outside to call you, though.
No. 218-731-1578.
Thanks, John.
Yep.
Any politics?
No, I meant you can go home and watch it today and get all you want. It's very different than 2016 for the little I have seen so far.
So far, yes.
Yeah, very different. But no, get ready for that too.